What will spark the market's next big move? The experts can't agree. CNBC's Halftime Investment Committee gathers to debate the key factors that could drive the next shift in the financial markets. But with so many variables in play, which catalyst will actually tip the scales? And are investors truly prepared for what's coming?
Should have eaten into it. We should have been stretched a long time ago. Credit card debt had gotten to these all-time highs. That should have been a problem, especially with interest rates where they were. I could go on down a list of why the consumer should have been under pressure. The consumer has been under pressure. What's happening right now is because goods prices have increased. When you look at things like core goods, ex autos, so the stuff that people spend money on besides cars, it's increased a lot month over month. I think it's up 0.6% month over month, and that's the highest level that it's been in a while. Consumers are just making choices now. So we have to spend more money on goods, which means we're going to spend a little less money on services, and then you see the market react to that accordingly. It's not that consumers have pulled back across the board and said we're not going to spend. So I do still think we're in a good place, and I have long said and still believe the consumer will keep spending as long as the consumer is employed. Now, we had a rough jobs report last week, but it wasn't negative, right? We didn't contract in jobs.
Right, because as Brian Moynihan said yesterday, job growth slowing is different than jobs being eliminated.
Exactly.
We haven't seen layoffs.
That's right.
So the labor market's slowing a bit. You want to be negative, the market, in the face of what I said, all this cash that needs to be deployed? Fed speak becoming even more dovish. You know rate cuts are coming. It's just a matter of when, not if. The consumer's hanging in pretty well. Oh, yeah, and the idea that the mega caps are going to continue to lead this market higher, that the money's going to continue to flow to the best and the biggest, and therefore the market's going to go up. At least the S&P, even NASDAQ. Hold on, Weiss, I'll come to you in a moment.
Even given everything Liz just gave us about the consumer and all the yeah buts that the consumer has given us in return, right? Yes, I should be negative, but I'm still out spending. I'm still of the mind that we should be focused on spending our dollars, or investors should be buying companies where enterprise is who they rely on, not necessarily the consumer. So yes, the consumer has shown a lot of resilience, but when I look at the companies that have done 25% or better year to date, I'm talking about Microsoft, I'm talking about NVIDIA, I'm talking about Broadcom. None of these companies sell anything to the general public, but when I think about the companies that do touch the consumer, Tesla, Apple, Amazon, they're negative year to date. And so I'd much rather own anything that's enterprise related, enterprise tech especially, rather than relying on the consumer right now, which if there are cracks in the system at any moment, those cracks could start to really break out. And now we're talking about trying to catch a fall.
Let's be clear. I don't bring up the consumer number as a question as to whether you should buy retail stocks. No. Those are two different arguments to have. But if you have a 2/3 service-based and consumption-based economy and the consumer's hanging in there, my point to you is, were you really going to get negative as long as the consumer continues to hang in there, and as long as the job market remains at least, maybe it's tightening, maybe you're going to have a slow of job creation. But as long as you don't have layoffs, that changes the equation altogether. You want to get negative the market in the face of that?
But at what point does that break, right? How many layoffs is enough to suddenly make the entire street decide maybe we ought to go in a different direction, right? We're starting to reach a capitulation around the idea that something's got to go wrong because we're all feeling too good right now. That's the mood with all the different investors that I talked to today. And so if you think about where you usually are supposed to zig when the market, when general consensus zags, I think that's probably a case for if the labor market does start to show one more crack, is that enough to start to force us in the other direction?
I don't know.
I just don't want to be in position to have to catch it.
Though. Like some of those measurements have already hit and the market still held up, right? I remember when the SOM rule hit and everybody freaked out. And then there's another measurement, I think Gunlock talks about the moving average of unemployment when the 3-month moving average gets above the 12-month average, something like that. I don't know exactly. All of those metrics have hit already, and it didn't fall apart. And I am guilty as charged, somebody who looked at all of those and said, uh-oh, here we are. Here's the precipice of disaster, right? Just waiting for this next big thing to happen. But then it didn't. So I'm not saying that it won't, but you can't invest based on just waiting for those metrics to then tell us, okay, surefire, this happened, here's the number, now we're headed for recession, because this has, again, been the recession that just never came.
That's right, Weiss. The the what-if investor has been run over by this bull train.
Yeah, no, absolutely. And look, it's just an unusual market. I've said repeatedly, we've got a different cohort, a different population that are investors now and active investors, and they really don't get focused on fundamentals. Just want to take 1 second to address what I said about momentum. I'm not a momentum trader. I believe in the strategy, which is why Joe T is one of my larger positions, because I know Joe does that well. Now, back to everything you mentioned, but I want to focus on the consumer first. Moynihan came out and said consumer spending through the end of July is up 5%. Malcolm's point was that we've got Microsoft, we've got NVIDIA, we've got, Apple. The CEOs, they're all diplomats. Well, guess what? So are the CEOs of other companies, everyone, because everyone could be singled out. So Moynihan in particular, he made that comment. He made that on the heels of being attacked for not banking conservatives. Now, July is an important date because you're a consumer, you went to buy a car, it said buy before the August tariffs hit. So there's a lot of pull forward buying. Don't take past as prologue. That's going to peter out, and we're going to see it peter out. And yes, credit card balances remain high. So there's a danger of being complacent in this market.
So are you negative the market again? Now I'm confused, Weiss. Where do you stand on this market? Are you growing negative on the market again?
I'm fully invested till further notice, but if you look at my positions, which I talk about often, I'd say 70% of my exposure is in big cap tech. So I'm playing it. I own Caterpillar to balance a little bit, FTI to balance a little bit. So I'm staying with the market, for now, but I'm not complacent. There may be a drawdown of 5 to 10%, but we'll recover quickly. So I'm not looking to time this market.